My name is Tim Gray, and I'm the Executive Director of Environmental Defence Canada. I'm happy to be here with you as we explore the power and potential of legacy giving and the role it plays in sustaining and amplifying our work on environmental protection for generations to come. I would like to acknowledge that I'm in the ancestral and traditional territory of the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, who have stewarded this land from time immemorial. This land is now, this land is now home to many diverse First Nations, Inuit, and Métis people. I also want to acknowledge that we are invited into the Dish with One Spoon Wampum Agreement in the spirit of peace, friendship, and respect, and the territory is covered under the Toronto Purchase of Treaty 13 and the Williams Treaties. Today, we are all calling in from many different locations, and I encourage all of us to learn about the land we are on. I hope that in taking a moment to acknowledge the land, we're also reminded that it is Black, Indigenous, and people of color who are disproportionately impacted by pollution, climate change, and environmental injustice, and that much work and change is still needed to address these issues and environmental racism. As we begin our discussion, I'd like to take a moment to share who we are and what drives our work at Environmental Defence. For 40 years, Environmental Defence has been actively engaging in environmental issues at all levels of government by working with policymakers, communities, civil society organizations, and the general public. We educate Canadians about environmental issues and provide meaningful ways for people to become involved and create change in their communities and lives. With a worsening climate crisis, more toxic and plastic pollution, and threats to our farms, forests, and wetlands, it's never been more important to choose new and better ways to produce energy, foods, and materials for our benefit and for future generations. Regardless of your reasons for becoming a legacy donor, or if you're simply curious about legacy giving, we must discuss your plans. You must discuss your plans with a financial advisor to best understand the financial implications. Systematic estate and trust planning helps secure a brighter future and a strong legacy for individuals and their families. Today, we're absolutely thrilled to be joined by an expert who has been providing comprehensive estate, incapacity, and trust planning services for over 7 years. Please join me in welcoming Ms. Paula Lester, the Associate Vice President, Estate and Trust Solutions at Solus Trust. Thank you for joining us, Paula. And just going to give a little bit of background on Paula. Paula is passionate about using trust and estate services to provide protection to clients and their families so they may avoid the unfortunate situations she witnessed as an estate litigator. She holds an undergraduate degree in psychology, a law degree from Queen's University, and she was on the Dean's Honor List, and a trust and estate practitioner designation. She clerked at Superior Court of Ontario before entering private practice. Paula is also an avid runner, ultimate frisbee player, and triathlete. And as mother of 2 young boys and a passionate animal lover, she opens her home to both rescues and foster pets. So it's a good thing that she is a triathlete, I think, given all those responsibilities, because she's probably spending a lot of time running. Paula, welcome.
I am, and it's always with a dog or a child on a bike alongside me. So thank you so much, Tim. I'm just going to take a moment here to share my presentation. Bear with me. And get that started. Perfect. So I'm very happy to be speaking on this topic today. As Tim mentioned, I started out in litigation. I've seen what happens when we don't have careful estate plans and good wills drafted and so on. And I'm also very, very passionate about the charitable legacies that we can leave and how we can make an impact in the world. And as the mom of 2 young children, environmental impact is obviously a very large part of what I care deeply about. So happy to share this. So we're going to start today with talking about why it's important to have a will. What are the benefits of having a will? And then we're going to delve into the charitable giving piece. So why do people give? What are the benefits of giving to charities? And then we'll talk about also the tax benefits. And the tax benefits are never really what should drive our desire to give to charities, but I always highlight what the tax benefits are, because at the end of the day, it ultimately leaves us or the charities or our family more than we thought we had to give once you factor in the tax benefits of giving. And then we'll talk about, well, what are the ways to give, and kind of go through a few myths about charitable giving and discuss those. As Tim mentioned, we'll have time for Q&A at the end, but please submit your questions as we go along. More than happy to answer them when we have time at the end. So, why is it so important to have a will? Will is the cornerstone of a good estate plan. It's not the only piece, and we'll go through, some other aspects that relate to your estate plan when it comes to charitable giving. But having a will is really where you get to say what you want to have happen to your estate. And surprisingly, about half of Canadians, adult Canadians, do not have a will. So about half of us are leaving it up to the laws of, if you're in Ontario, or whatever province you might be in, to dictate what should happen to our assets, our bank accounts, our investments, our home, our car, all of that when we pass away. And that's not actually always the way we think it's going to go. Certainly, if you had meant to leave something to charity, a charity is not going to receive, because the first person to receive is typically a spouse, but it can also be spouse and children dividing. And then it may be your parents, if they're still living, your siblings, and so on. It kind of runs down a family tree in order of priority. And this one I always throw out there, under Ontario law, if you are in a common law relationship, that spouse, even though you say, that's my spouse, we file our taxes together and so on, they actually don't have a right to inherit under the laws of what we call intestacy. So if you do not give to them in your will. So very important to make sure that you have a will that really lays out where you want your estate to go. The other reasons why it's important to have a will is because you get to decide who is going to administer your estate. So, is it your spouse that you want to take care of dealing with all of your finances after you've passed? And if your spouse has passed, who would you like to take care of things then? Is it your adult child? Is it a sibling? Is it a professional like a trust company? That's a really important choice to make as well, because, and I'm not going to get into it too deeply, that's not the topic today, but executors have a lot of responsibility, obligations, and also power when it comes to administering your estate. And so you want to make sure that it's someone who's really suitable for the task. And if you don't have a will, even if the default executor under Ontario laws and the default distribution under Ontario laws, or again, whatever province you're in, kind of aligns with what you would want to have happen, it still is much more difficult, time-consuming, and likely more expensive for your executor, again, executor not under the will, but at law, to administer your estate. And so one of the best things you can do to leave a good legacy for the people who come after you is to do your estate plan, have an up-to-date will, make it easier on them at a time in their lives where it's not easy just by default, because they will have just lost you. So hopefully my pitch to get a will done has landed home, and I don't need to say any more about that. So let's switch over to giving. Giving in life, giving after we've passed away, through our will, through our estate. Why do we give? Well, not surprisingly, I hope, the big part of why we give is because we have compassion towards those in need. We see a need, we feel that we feel for those who are affected by this gap, this need, this lack of resources or lack of services, and we want to help fill that gap. So we tend to give towards what we feel is a worthy cause. And of course, that's the second part there, but personal belief in the cause. You'll see that there are other aspects. Obviously, if we've been personally affected, or if we feel we will be personally affected, that's very true when it comes to environmental charities. For me, it's not, yes, I'm being affected every day, but it's not affected in the sense of, I've had an illness, so I'm donating to that cause. It's affected more in a, this is ongoing. This will continue to affect me. This will continue to affect my children and my children's children. So that's obviously important. I know for me personally, that speaks a lot to that. And then sort of dropping off is, if we've been asked, religious obligations, that's becoming less prominent as we become, in Western society at least, a little bit less religious. And tax credits, thankfully, are not the driver of charitable giving, although they are a nice little benefit there. So that's why we give according to what people have answered in a survey. But what are the benefits of giving? What are the benefits first for charities and for society? And this one, I have 3 squares here, but they're very large concepts, right? And I could go on and on about the ways that charities benefit. And I know Tim could speak to the way that Environmental Defence Canada benefits everyone, the good work that they have done. But boiling it down a little bit, 1 in 5 Canadians used a charity for an essential need in 2023. And that's against the charities where you can directly say there is a link between usage and benefit. So, the ones who used, they needed access to food or shelter or education or other services. That's a lot of Canadians, right? That's 20% of Canadians. And charities often are reporting that they do not have enough resources right now to meet demand. The other piece with charities is that as much as we vote and we hope for a government that's going to sort of meet societal needs and put funding where it's needed, we know that even under the best of circumstances will never fill in all the gaps. So we are being able to fill in gaps not met by the government or business under a system that's not political, not in the same way. So we are able to put our money, maybe allowing those dollars to go further in terms of being able to address different concerns. And that's the other benefit of giving. Of course, we play our part in allowing charities to target immediate and long-term concerns, again, in a field that's not governed by needing to get votes. So charities fill a very, very important place in society. And of course, we want to see them have longevity, and particularly the ones that we feel serve areas that we feel are the most pressing needs, or needs that need to be met long-term. But there are also personal benefits of giving, of course. And I think a lot of the personal benefits of giving have to do with connectedness. So there are many studies that show giving and also volunteering lead to greater happiness, lower stress levels, lower blood pressure, actually, as well. We see better physical and mental health. So it actually is linked as well to longevity of life, increased connection to others, and financial literacy. So I want to delve a little bit into a couple of these. So in terms of increased connection to others, we live in a society that is increasingly becoming individualized, and where family members are often moving away. A lot of us may not have a lot of close family members. Maybe we haven't had children. Maybe we have one child. That child may not live here. The number of siblings we have, cousins we have is generally getting smaller. And especially as we age, and this is an area that I work in a lot because I work with a lot of aging clients by nature of what I do, I noticed, and there is, survey evidence to this, that those who are involved with charities keep this connection that they're not necessarily finding elsewhere. It helps them feel valued. It helps them feel like they're a part of something greater than themselves. It fulfills what seems to be a basic human need, to be involved and connected to others, connected to society. And that in turn leads to the other benefits, which are the better physical and mental health, lower stress levels, greater happiness. Financial literacy is a really interesting one because, again, just by virtue of the job that I do, I manage to see what happens as money moves generations. And those who build their wealth tend to have an appreciation of money that those who receive wealth don't always have. And so we know that inheritance is often lost by the second or the third generation. So someone who's receiving $500,000 as an inheritance, that may seem like a lot of money, but without financial literacy, they are apt to spend that very quickly. And we see it also with lottery winners all the time. There's this big issue with lottery winners. They don't know how to manage that wealth. As family or as connected individuals, we often we there used to be a view that we cannot talk about money. And we're learning now that we have to talk about money. We have to talk about budgeting and taxes and all of this. Philanthropic giving is another area of financial literacy, and it's a really great one that works in the human and the social connectedness into our budgeting, into the way we view finances, but it also the lessons we learn bleed into the other areas of our life and help us to be better at managing our finances. So that's an added little bonus there that I think a lot of people don't think about when they think about philanthropy. And so now we're talking about all these benefits, personal benefits, benefits to charity, benefits to society. I'd really like to introduce Eric Stevenson, one of Environmental Defense's longstanding and loyal donors. Eric is not only a donor and active supporter of Environmental Defense's work, but he is currently a member of and the past chair of Environmental Defense's board of directors. So welcome onto the webinar, Eric. And I'm going to stop sharing and give you the spotlight to speak.
Thank you, Paula, and hello, everyone. It's my understanding that all of you attending are already donors, already supporters of environmental defense, and that many of you are, in fact, longstanding donors. And on behalf of the board, I say again, thank you. We're for as Paula has mentioned, I've served on the board for something like 20 years of environmental defense, and for a long time have been on the finance committee, and in fact chaired that committee, which will be relevant to what I want to say. And as noted, I'm also a past chair of the charity. My family made a substantial donation a few years ago to environmental defense, and now have, as a family, and after discussion amongst with my wife and daughter, we've decided to make a bequest to environmental defense in our wills. While the decision was kind of sealed quite a few years ago, when my daughter was in grade 1, she had a class project to make a collage about a person in her life who was important to her, and she chose me. And one of the things, besides a stuffy picture of me on the collage that she wrote, was, "He's always there for me, and he does good things for the earth." And after I stopped blubbing on reading that, I realized that that had kind of sealed the decision. So why environmental defense? Environmental defense, you already know environmental defense's track record if you're a donor, and that track record speaks for itself. They get results. In my experience on the board, my fellow board members and I are all type A. We like helping to run one of Canada's largest and most effective environmental advocacy charities. We like growing that charity. And one of the considerations is, I think, staying power. This is our 40th anniversary. We were established in 1984. Environmental defense is in the best financial health it's ever been. It's sad to say, certain provincial government is quite good for business, but I have every confidence that environmental defense will be around for another 40 years. So staying power. And finally, in my years on the finance committee and chairing it, I have become acutely aware of how carefully our dollars, our donations are stewarded. Our audits are always clean. The management reporting, the quarterly finances are always precise. No penny that we give as donors is wasted. There is no fat. There is no excessive administration or wastage. So very briefly, that's why I'm a donor to environmental defense.
Thank you, Eric. And I'm just I really hope that that message got through nice, loud, and clear. I know that Eric's bandwidth was a little bit low at times, but I think I was able to hear the whole story. I hope everyone else was. Eric, that is a really wonderful story, and I absolutely adore the piece about your daughter. There's nothing more insightful than the way that our children see us, and we hope that they see us as the people that we want to be. So I'm going to go back to sharing my screen here and go back to the presentation. Hoping I'm sharing the right version here. Someone send me a message if I'm not. So just, I'll take a pause here again, just to remind everyone, there is a Q&A chat box that you can put your questions in if you have them. So please go ahead and do that as they come to into your head, and we'll get to them at the end. So moving along past Eric's story here. All right, so let's talk about taxes. So this is probably one of the more complicated aspects of the presentation, and I will do my best to make it as simplified as possible. When I went into law, I promised myself that of all the areas of law, the one I did not want to get into was taxes. And then I moved to estates and charitable giving, and a lot of it is taxes. So if I was able to learn it, hopefully I'm able to impart it, and you'll leave here with a little bit more tax knowledge than you had before. But basically, I'm going to start by talking a little bit about how taxes work, and then we'll go through some sort of scenarios to explain better the benefits of donating from a tax perspective. So Canadians, as we earn income, we are taxed on a graduated tax basis. So the first dollar I earn is taxed at a lower amount, 20% in Ontario. And the more I earn, so if I earn over $253,000 in a year, for example, it will be taxed, increasingly more, and up to the highest tax rate in Ontario is over 50%. So it really depends on what your income taxes is, but basically there's, what your income for the year is, you have a certain tax rate. When you pass away, so this is the other aspect, sorry, I'm going to backtrack a little bit. As you may or may not sort of be aware of, there's taxes when we earn income from our employment, but there's also taxes when we deal with certain assets. So if I pull money out of my RRSP, that's taxable as income in the year I pull it out. And if I have investments sitting in a non-registered portfolio, so not an RSP, not a TFSA, just a regular investment portfolio, and I were to sell those investments, those stocks, I pay capital gains. And capital gains, not to get into too much detail, but the taxes on capital gains are a bit different than the taxes on strict income. And it's similar, if you have an income property, so you own a home and you own either a rental or let's call it a cottage, if you were to sell that second property, you would pay capital gains on that as well. So, but if I were to sell my home, there's a principal residence exemption. I don't pay any taxes when I sell my home, my principal residence. So every aspect of our lives kind of has a different tax treatment. And why I bring that up is because when an individual passes away, the day that they pass away, they are deemed to have disposed of all of their assets that day. What does that mean? It means from a tax perspective, CRA treats it as though the day that you passed, you pulled out all of your RSP, you sold all of your real estate, sold all of your stock, all of that. And whatever the tax treatment would be, if you actually did that all in the same day, is the tax treatment you get on death. Now, if you have a spouse, you can actually defer that until you have both passed away, but once you both pass away, there's this large deemed disposition and typically a very high taxable event. So if you can think about it, if I have an RRSP worth $800,000 by the day I pass away, if that all comes into income in the year that I pass away, that's $800,000 of increased income on my tax return, my last tax return. That puts me into the highest marginal rate. And basically half of my RRSP, 50%, would go to taxes. So when I talk to a lot of individuals, they think they have a lot to give to their family and so on. But when we look at what the taxes might be on death, it can reduce their estate by quite a bit. Now, the good news is when you donate to charity or other qualified donees, you get a charitable tax receipt. It's a tax credit that you can use to offset the taxes that would otherwise be owing. So if I give $200,000, and I know I'm using large amounts of money, but $200,000 to a charity, then I can offset about the same amount of taxes that I would have owed on that $200,000. And individuals claim it as a tax credit. If you happen to have a corporation, a holding corporation, which I know is not necessarily going to be common to most of the people on this webinar, and you were to donate directly from your corporation, you can claim that as a deduction from income. So if you donate now while you're alive, so I donate, let's call it $10,000 this year, I can claim up to 75% of my income for the year. So let's say I made $100,000 this year, and I make donations. I can reduce my income by about 75% and only pay taxes on that $25,000. Now, in the year of death, I can do it up to 100% of the income. So I can actually, depending on how much I leave to charity when I pass away, I can actually fully wipe out my tax bill on death. And if I donate today, a large amount, more than I can use to offset my income today, because I've used it to offset 75% of my income, so that I'm not paying taxes on 75%, but I still have more charitable tax receipt that I didn't use, I can carry that forward for 5 years. And if you're married or common law, you can pool your donations. You can claim them on one return if one spouse is making more, up to that personal limit of 75% of income. Similar for corporations. Again, if you're donating from a corporation, you can claim a deduction for the income earned by the corporation up to 75% of the net income for the year. And again, any unclaimed tax credits can be carried forward up to 5 years. Where I'm going to go through some examples to show you what that might look like. So that's the basic benefit of it. So if I donate, what we say is if I donate $1, it's basically $1 I don't have to pay tax on. So if I was getting taxed at maybe call it 30% because because that's the tax bracket I'm in, well, then I'm actually donating $1, but it's only setting me back 70 cents because 30% of that dollar would have gone to tax anyway. So that's the donation of cash. If you donate cash, $500, $1,000, you get a tax receipt for the value of that gift, that $500, that $1,000. Now, for those of us who are blessed to have stock, securities, investments in a non-registered account, so not in our RSP, not in our TFSA, not in our first-time home buyer's savings account, not in our registered, our RESP, all those lovely plans, but just sitting in a normal non-registered investment account. If I have stock sitting there, if I donate that stock in kind, so let's say I purchased a Bell share. When I purchased it, it was worth $100. 5 years later, it's worth $500. So I want to, instead of selling it and donating $500, I'm going to say, I'm just going to donate the Bell share. It's worth $500, but if I were to sell it, because I purchased it for $100, I'm selling it for $500, I would pay capital gains on that $400 difference. I'm going to donate the share itself to environmental defense, and it's worth $500. Well, what would happen is environmental defense would give me a tax receipt for the worth of the share, $500, and I would never ever have to pay taxes on the $400 gain, but I would still have a $500 tax credit that I could use towards my other income in the year. So I work with a lot of clients, if they are in a situation like this, able to donate these types of stocks out of a non-registered portfolio, that's often where we look because it gives an added tax benefit. They never pay the tax on the capital gains, and they have a full tax receipt for the value of the stock that they can use towards offsetting other income. I do apologize if this is complicated. Please feel free to put it in the Q&A if you're not following along or if you have any questions. And then, of course, you can, as I mentioned, give gifts from a holding company, which is, if you do happen to have a hold company, really, really beneficial because corporations are taxed at a lower rate than people. So you will not have paid taxes around the first time around. You will get the tax benefit of making the donation to offset other income in the holding company. And it just ends up being a lot more dollars in your pocket at the end of the day. But I'm not going to focus on that one because I understand not a lot of us have holding companies. So if you do have that and you have questions about it, please let me know. But for most of us, we're not going to focus on that. So here's my tax example of giving. So let's say Mary, our hypothetical donor, she passes away with a RIF of $800,000. And if you recall what I said, when you pass away, you are deemed to have liquidated, to pull out all of the income in your RIF. And so that $800,000 is all income in the year that she passes away. And let's say she also has other investments, stocks, sitting in her non-registered of $500,000 with capital gains of $340,000. What that means is when she bought the stock, when she first put money in, the amount of money she put in to buy the stock was $160,000, and it's grown in value up to now $500,000. Okay, so on her death, Mary, without taxes, 800 plus 500 would have an estate of $1.3 million. But because all of the RIF is income the year that she passes, and because some of the capital gains are income, Mary would actually have $965,000 of income on her tax return. And from that, if you look in the no donation column on the table, she would pay taxes of almost $500,000, taxes of $486,490. And so she would have about $800,000 left to give to whomever she wanted. But let's say Mary wanted to give to charity for part of her estate. And she thinks, I don't have all that money to give, before she passes away. But we do an analysis and we say, well, Mary, what if you just gave that $500,000, the stock as is on your death to charity? How much would that actually cost you? How much would that actually remove from your estate such that you no longer have it to give to your family? Well, if we do the calculation, so I'll run you down the donation column, the RIF income would still be considered income because we're not donating that. It still comes into her estate, it's still income. But because she's donating the securities, the stock, when she passes, there's no capital gains included in her income in the year of death. So her income now is just $800,000. So that's what's going to be taxed. So the tax on that to start with is already lower. It's $387,460. But because she donated a value of $500,000, she also gets a tax credit of $200,000 to $760. So when we look at all of that, Mary only pays taxes of $186,000 compared to the $486,000. So she's donated $500,000. She's also paid taxes of $186,000. Now she has just over $600,000 to give to family. So yes, the charitable gift did take more from her estate than if she'd just paid the taxes. But if you look at it in this circumstance, Mary was able to donate $500,000 on her death, while it only taking $200,000 out of her estate. So she still has quite a big chunk to leave to family. So this is just an example. Not every estate's going to look like this, but sort of at minimum, I would say every donation you make on death typically only costs about 50 cents on the dollar. So when you're looking at how much is this going to come out of my estate, and you think about the tax benefits, a $10,000 gift is probably only going to cost your estate at $5,000 at most. Probably. Again, I'm also not an accountant, and every person is different, but that's sort of the general rule of thumb. 5,000, like half at most, and you can get it down to, costing less than half of the actual gift. Now that we've done all that fun, we'll turn to much easier to grasp, I think, topics. And take a look here. We do have a Q&A, and I will answer that at the end. So how can I give in my will? What's the best way to give in my will? So it depends on how much you want to leave and to how many charities. There's a few different ways that you can leave when you pass money to charities when you pass away. So the first way is, I'm thinking of leaving sort of a smaller amount to charities. I have an estate with my house included of, let's call it $800,000 or $1 million, but most of that I want to go to my children. I want to leave, let's $10,000 to environmental defense. In those cases, the best thing is to just write that in exactly into your will. I gift $10,000 to Environmental Defense Canada, and you would include their charitable registration number to make it very clear what charity you're talking about. You don't need to do any more planning for that. Now, if you want to leave a larger part of your estate to charity, so this is the second option. So leave a portion of your overall estate with or without additional planning. So let's say my estate, again, it's $1 million, but I'm going to leave 5%. We would frame it as a portion, but 5% of my estate to charity. So 5% of $1 million is $50,000. And I'm going to leave it to 5 different charities. Well, now I've basically just left $10,000 to each charity. So I'm leaving it as a portion of my estate. So if my estate gets larger, that portion goes up. If my estate gets smaller, that portion goes down. But because it's about $10,000, unless my estate really changes, it's about $10,000 that I'm leaving to each charity. You don't need to do additional planning with the charity. So that might be where you leave it. But let's say, again, in a $1 million estate, I'm going to leave half of my estate to charity. And let's say it is just one charity. It's environmental defense. Well, now I know I'm going to leave them around $500,000. I may want to let environmental defense know that this money is coming, and I may want to engage in a plan with them as to how they might use it. And if I do have particular causes within the charity's sphere of what they do, I may want to enter into a plan with them that my money would be used towards those causes or programs. Some people say it's not really the route I want to go. Either things are like, I don't really want to deal with the charity directly right now. I don't want them to know that I'm doing this, but I do need some more advanced planning because it's a larger sum. Or maybe I'm giving to a lot of different charities, but that might change all the time. I found this charity I like, and then tomorrow I found that charity I like, and I don't want to update my will every single time. Or maybe you're leaving a larger sum of money and you don't want it paid out all at once to a charity. You want it paid out over time. That's where clients will typically use what we call a donor advised fund to structure your giving. And there are a few different ones of these. You will have heard of community foundations. We have the Ottawa Community Foundation, the Toronto Community Foundation. I work as part of, Solus Trust is part of Raymond James, which has our Raymond James Canada Foundation. Most financial institutions will have their own, but they're all essentially the same. They have slightly different criteria and such, but they're all essentially the same. And what they do is they themselves, these organizations, are set up as a registered charity. So when the gift is made to them on your passing, your estate will get the tax receipt. But they're effectively just used to funnel the money ultimately out to the charities you want. So let's say I'm leaving $500,000 to, and I don't know that this is true of environmental defense, but to a charity that can't handle that sum of money, and I want that paid out to that charity over 5 or 10 years. I will, in my will, have that money go to whatever donor advised fund I have chosen. And with that organization, I will have paperwork in the background that says, you're to pay this out to Environmental Defense Canada over 5 years. So So in your will, you've given it to a charity, so you get the tax receipt, but in the background, it's just a vehicle to ultimately get the money where you want it to go. And that could be one charity, it could be multiple charities, and so on. So if that's something that sort of speaks to you as, oh, that feel like that kind of makes sense in terms of me, I want to put one thing in my will and then be able to change the charities in the background as much as I want, or I want one thing in my will so that it can be paid out over time, or whatever the case might be, that's a good vehicle as well. And then the last one is to actually establish a charitable trust or foundation. So you would have wording in your will to do that. That's pretty rare. Those are ultra high net worth individuals that are leaving, I wouldn't even say $10 million. Like I'm $20 million plus in terms of these lasting legacies. And we talk about these philanthropic families for generations. Like those are the types of individuals that have those. If you're one of those individuals, we could chat about that but offline, but I take it most donors in Canada are not. So my last slide here before we get to Q&A, and again, I'm just checking up here. So I'll answer some questions at the end, but so some myths around giving. So myth one, I don't have enough to give. And the truth is any amount is helpful, right? When you pass away, maybe it's just $1,000 that you want to give to the charity because you do have a small estate or because you do want most of it to go to family. And because maybe the tax benefits, although great, don't offset the fact that you are going to be left with like slightly less in your pocket by giving when you give to charity that you could not give to someone else. $1,000 is great. Charities are happy to have it. But the other piece is, as I've shown, it's really advantageous to get an understanding of how much you're actually removing from your estate net of the tax benefits by doing charitable giving, because you may be reducing your estate by much less than you think. And therefore you're able to give more than you think, because at the end of the day, you have more after taxes to deal with. The other myth that I hear a lot is that charities have too much overhead. And this is not true. You want to talk about overhead? Not that I'm anti-government, government's too good, but that's bureaucratic, very bureaucratic. Charities are highly accountable. They often provide or always provide these impact reports on where their money is being spent. And in general, like over the landscape of charities, 1% is spent on administration. That's that. Actually, sorry, 1% is spent on fundraising, 9% is spent on administration. And the actual charitable activities make up 86%. And that's going to vary depending on the charity. But the other piece is administration. Like, we need to keep the lights on. We need to pay people well in order to retain good people to do the work that we want and need charities to do. And I think that gets overlooked a lot, right? The people who go into the charitable sector are already making a sacrifice on their earning potential. But they do need to have, a certain amount, especially in cost of living increasing. So paying people well is not against the charitable goals. It assists the charitable goals because it allows the charity to be run by good, knowledgeable professionals. So I advocate for that as well. But in general, just when you look at this pie, and you can look at many charities reports, they don't have too much overhead. And then the myth 3 is charities are aggressive and hard to deal with. So you let them know money's coming, they're going to hound you for more. You leave to them in the estate, they're going to be greedy for more and hound the executor. There certainly are charities take different approaches in terms of how they speak with donors, how they correspond, and certainly they try to get as much money as possible to do the good work that they do. Again, every charity is very different. Environmental defense as a donor already. And as much as I do very much encourage letting charities know if you have left them in your will, particularly if it's a larger gift, because it allows them to plan, it allows them to understand what's coming, allows them to engage in further planning with you, if that makes sense. If that is a concern, I would suggest using something like a funnel through donor advised fund. If you're saying, I really want to be anonymous, but I want the money to go to them, donor advised funds can do that. So there are solutions depending on what it is that you're looking for in terms of how you make your donations. And just a few little statistics here. 77% of charities make less than $500,000 per year. 90% employ 10 or fewer full-time staff, and 59% have no full-time staff. So charities are running on as much bare minimum as they can, especially the smaller ones. All right, so this is me. And this is my disclaimer, especially as I went into those tax pieces. Nothing in here should be construed as tax or legal advice. Your situation is going to be different. Your estate planning needs are going to be different. Please make sure you're consulting the correct professionals around all of that. And now, with all of that, I am going to stop sharing and take a look here at some questions. So some questions and some comments have come in. So there's some lovely, I think it's in the webinar chat. So if you look down at the webinar chats, I believe this is stuff that's been shared. Oh, maybe not. So I'm going to just run through some of these things that I was told by Environmental Defense while I was going through my presentation, that it is a charity that is able to handle larger amounts of money. And again, I strongly recommend letting them know it's coming, doing some planning if you need to. And we're going to, open it up to the questions. I believe, Tim, you were asking me the questions.
Yes, I'm going to be doing that. Thanks so much, Paula. I think we all learned a lot about legacy giving this afternoon. I know that I did. For those of you who cannot stay for the Q&A, I want to highlight how you can get in touch with us. If you're considering a legacy gift or you would like to learn more, we'd be delighted to connect with you. So please feel free to reach out to us at legacy@environmentaldefense.ca for a private and no obligation conversation. We are not a hard sell kind of organization. We can help answer any questions you have and explore options that align with the legacy goals that you might have, as Paula's described. And so thanks so much for joining us today. We also, I think I'm going to put in the chat a link that you can fill out a form that will help us get in touch with us, or that email, legacy@environmentaldefense.ca. So let's have a look in the chat over here and see if I have some questions.